We'll get started. Welcome to our webinar, I guess, on student loans, both private and federal. My name's Melissa Bassett, and I head up the in-school lending program at SoFi, and Debbie Schwartz has been our longtime partner. How many of these are we up to now, Deb?
I know, this is
A
definitely, third year. Yep.
Yep. And she is the co-founder and the head of Road to College, which I'm sure many of you have found us through her and her website. And we do about 4 or 5 of these webinars each year on merit scholarships, looking for aid, how to find the right college, and then, of course, financing your college education. And tonight we're going to specifically focus on loans.
Melissa, you don't happen to have, and if not, I'll look for it later, the link that has all the other webinars, because particularly for the families with 11th graders, it would be, if you missed any of the previous
that's a great idea.
Webinars, it will be helpful for you to go back and look at those. And then kind of combine the information from those webinars with what we're going to talk about tonight.
Yeah, and we will actually email it to everyone. So we will email it with this presentation, a link to all of it.
Okay,
so
that'd be
you can
great.
see the other ones. So, all right. So with that, we'll get started. And I just want to stop right here. Little legal disclaimer here. We will email this to you after the fact, but we will be talking about products tonight. And so we always like to say right up front that private loans are no replacement for federal loans, which Debbie's going to cover right when we get started. This will not be a product pitch. No one is required to take a product, do anything with a product, but we'd like to just make sure that everyone knows who SoFi is. We are not only a financial technology company, but a bank. And welcome to everyone from our at-work partnership or our high school counselors or just members that are here to learn about loans. And here we are. Good, the two of us. Debbie, anything you want to say about Road to College?
No, I mean, hopefully if you found this presentation through Road to College, you know that we provide a lot of education on the college admissions process, and particularly with an eye towards how you're going to pay for it, because the two processes, figuring out where you're going to go to college and how you're going to pay for it, really need to be intertwined. And I love working with Melissa and SoFi because we continue to educate parents about the process, and particularly where we are now in May, kind of, going into the summer months, particularly for families with high school seniors. You need to learn about the loan stage of the process, but it's fabulous for parents of younger students because you'll learn about what all these loans are about, and then you can decide to factor them in or not into your planning process during the admissions stage, and when you when you get to the point of choosing a school for your students.
Yeah, great point. And Debbie and I were chatting before we joined the webinar. We are experts in college financing because we have children in school.
Right.
So we were just chatting about the statuses of where our children were. My last one is graduating next Sunday, so I'm super excited about finally getting the kids out of college. So and Debbie has children still in college. So
Yep. So we live this, and for our work and for our family life as well.
Yeah, for sure. So we're happy to answer your questions as we go along. And then here's the agenda. We're going to talk about paying for college. Obviously, we're going to talk about federal loans, the difference between federal and private, when you need to apply, some loan tips, other options, and then we'll get into Q&A. Debbie and I usually keep a good eye on the Q&A during the presentation, though, so we will generally get to your question during the content if we see, if we keep an eye on it. So with that, Deb, I'm going to hand it to you.
Sure. Oops.
Well, here's our mission statement. I cannot forget this. SoFi's mission is to help people realize their dreams through financial independence. And that doesn't mean just being rich. It means making your money work for the life that you want to live. And this is we're going to talk about lenders, towards the end of the presentation. But one thing I always encourage parents to do as they're thinking about student lending, there's a lot of student lenders out there, but not everyone is a full service bank. Not everyone is a full service company. They may be there just to make the loan, and that's it. And it's something to think about as you're planning now. Who in my community, for example, like a credit union or a bank, is going to be there and is someone maybe that we use now. So it's a decision, to think about when you're choosing a lender, but we'll get to that later. All
So
right.
as many of you know, college has become one of the largest financial decisions that you're making for your family. We know that college costs have skyrocketed over the many years. If you're at this point in the process, hopefully, and this is why I pointed out the previous presentations that Melissa and I did, hopefully you did try and max out how much free money you might have been able to receive. And free money comes in the form of merit scholarships and private scholarships. And even before that, hopefully you've been able to, and everybody's situation is different, but save as much as you could have, whether it is in a separate savings account or a 529. But today we're going to talk about if you're at this point where your student has picked a college and you now have to figure out how to finance the gap. We're going to talk about the public, the federal loans and the private loans. I see already that somebody asked, which one is better. We're going to go through that. And honestly, by the end of the presentation, you may not have a decision, but you'll have the information to kind of go through and do a little bit more research and come up with a decision about whether you want to go with a Parent Plus loan or whether you want to go with a private student loan and how you're going to research it. So that's what tonight's all about.
Excellent.
So in terms of the federal loans, there's really two buckets of federal loans. One are for your students, and they are called direct federal loans, and they come in two types, and we'll go through in detail. They come in subsidized and unsubsidized. And then for parents, there's a loan called the Direct Parent Plus loan, which I'm sure you've heard a lot about. So the federal loans, and another word you might see, or a name you might see used for them, are Stafford loans. What's really important about these loans is that these are probably the only loans that your student can get just in their name without a cosigner. That's really an important piece of information to absorb. So people ask that all the time, or I'll see this question, well, I'm not paying for college. My student's going to have to figure it out themselves. Well, they might be able to, but they're only going to be able to go so far because they're only going to be able to get so much money only in their name. But this is that loan that they can get that's in their name. They don't need a cosigner. And the other important thing is, because it's from the federal government, it's also probably the loan that they'll be able to get the lowest interest rate on. And we're going to talk about how those interest rates are set and what the interest rates are. Just with a lot of other federal loans, if the student decides to take the federal direct loan, they'll have to complete an entrance and exit counseling. And then we're going to talk about that these loans come in two different types: subsidized loan and unsubsidized loans. And I'm kind of curious if anybody wants to put in the Q&A or the chat, particularly if you're a family with a senior, if you've gotten awarded subsidized loans or unsubsidized loans. And if you have, you would have seen it in the federal award, the financial aid award letter that the colleges send you. And hopefully it's also clear which amount is subsidized and which is unsubsidized. I know that there's a lot of issues with the clarity of college financial aid award letters, but again, if anybody has any questions about how to read their financial aid letter, please reach out. I'm more than willing to help. Hopefully you've done that by now, since decision day has already passed. But believe it or not, I'm still seeing people make decisions, and that's a whole nother conversation. Okay, so subsidized loans from the government are loans where basically the government is paying the interest, and the student is not going to be charged any interest while they are in school. Interest does start a few months after they graduate, but while they're in school, there is no interest on those loans. Subsidized loans are offered up to $3,500 each year, or at least the freshman year. And we'll talk about how much the total is that a student can receive in both subsidized and unsubsidized. And the school determines how much subsidized loans your student's going to receive. And the reason why the school determines it is because the school is determining whether your student has a financial need, and it's based on, to some extent, their cost of attendance. You might have seen, again, if you're a family that received some subsidized loans, that from some schools, your student was awarded a subsidized loan, and from other schools not. And it's because of the school determining how much financial need you have based on their cost of attendance. The unsubsidized loan, what's really important to understand about this loan is that honestly, any student can receive it. You do not have to have financial need. What's really important about both these loans and the Parent Plus loan is that the family and the student has filled out the FAFSA. That is your student will not be able to get the direct subsidized or subsidized loans. You as a parent, you would not be able to take out the Parent Plus loan unless you have filled out the FAFSA. So I know a lot of people say, oh, the FAFSA doesn't do me any good. On some level, maybe not, because you don't like what your EFC is, but the reality is one of the most important things it does do is it gives you access to these federal loans. So an unsubsidized loan is that as soon as your student is dispersed to the school, it will start accruing interest. And then each year, your student will be able to continue to take out whether it's a subsidized loan or unsubsidized loan.
Yeah, and I'm just using our fancy tools. It's open to everyone. That questions come up in the chat a couple of times. And so the FAFSA, the free application for, I'm always getting wrong, student aid, is a form that you complete every year, which determines what programs you're eligible for, whether it's need-based or non-need-based. I think there is a misconception, though, that you must be show need or demonstrate need to get the Stafford. So here I am, I'm dating myself, the direct subsidized and unsubsidized loan. But it really depends. The income comes in as to whether the student gets the interest paid while they're in school or not. So if you come above the threshold that's set for subsidized, you still get that $3,500 freshman year, or your student does, regardless of your income. All are welcome.
And Douglas made a comment, our federal aid sheet had the same amount listed for both subsidized and unsubsidized. That is just by chance, there's no it doesn't necessarily get split down the middle. That's just the way your situation ended up.
That's right. Excellent. Any other questions? Well, someone had a question, is there a limit? I think we're going to cover that in a second.
Yeah. So one other thing before we get to the limit, and this idea of an origination fee applies to both the federal direct loan for students and the Parent Plus loan, and it becomes a much more significant issue for the Parent Plus loan, and we'll talk about that soon. But basically, it's kind of like an upfront fee. It covers the cost of processing the loan. But why we like to point this out is that and in this case, the origination fee for the federal direct loans is 1.057%, is that it comes off the top. So you will be paying interest off the $1,000 in this example, but only $989.43 gets applied towards your student's bill. So there's always like a little gap. And you just need to recognize that. So people kind of get a little flustered when they don't see the full amount get applied to the bill. So here's the chart about how much your student can borrow each year. It starts off as a freshman. The total, and this is a combination of subsidized and unsubsidized, the total amount the student can borrow from the federal government is $5,500. And then it goes up from there, $6,500. You can see for sophomore, and then junior and senior, it's $7,500. And then if your student potentially does more time after 4 years, there is a max that they can only borrow up to $31,000. We listed this column of independent undergraduate, but I got to tell you, to some extent, just ignore it because it is so difficult. 99.9% of students are not going to be identified as independent, but we just have it in there because just to have full information. So the current rate of the federal direct loans, and I'm going to define when I say currently, as of today, if I needed to take out a loan, it would be 4.99%, and the origination fee is, I mentioned before, 1.057%. But we don't know yet what the interest rate is going to be for your student's loan when they have to take it out, and they won't be able to take them out until after July 1st. And that's because the interest rates are set by Congress and it hasn't been set yet. It's set by the 10-year T-bill rate, which gets the one that is set in May. So we are all waiting for that auction to happen. And as soon as that does happen in May, usually there's like a soft announcement, and we'll probably know by the beginning of June what the rate is, but officially that rate becomes known as of June 1st. And then that rate covers anytime your student takes out the loan from June 1st, in this case, June 1st of 2023, up until July 31st of 2024. So that was a lot of information about the federal direct loans for your students. Now I'm going to switch over to the Parent Plus loan. So the Parent Plus loan is a loan that parents can take out from the government. Your student has to be an undergraduate and enrolled at least half-time to receive it. What's really important to understand about the Parent Plus loan is that it is only in the parent's name. Just like the student direct loan that we just talked about is only in the student's name, this Parent Plus loan is only in the parent's name. And again, why that's important, and probably one of the big comparison between the Parent Plus loan and a private loan is that fiduciarily, if that's officially a word,
Very good. Very good.
your student doesn't have a responsibility to pay back this loan. So the financial responsibility is only on the parent. And it can't be transferred to the student. You can't say, well, I'll take out the Parent Plus loan and then I'll transfer it to you when you graduate. I mean, there might be ways, as we say here, you might your student might be able to take out another loan and use that money to pay off the Parent Plus loan. And then in theory, they're refinancing it, but you won't be able to just transfer it from your name to their name once they graduate. And again, to emphasize, the only way that you can receive the Parent Plus loan is by filling out the FAFSA. And let me just actually add this. A lot of parents may or may not want to fill out the FAFSA early in the admissions process because they feel like they might not get financial aid and maybe they don't want to disclose a lot of that information to the college. That's fine. Just so you know, you can submit the FAFSA anytime now. So even after the whole admissions process in theory is over, and now you never filled out the FAFSA earlier, and you might still want to take out the Parent Plus loan, that's fine. You can fill out the FAFSA now and then go ahead and get your Parent Plus loan. So don't feel like, oh, I didn't do it when the rush happened in October. I didn't fill out the FAFSA, I can't get the Parent Plus loan. You can anytime throughout the year.
Yeah, and sorry to interrupt you. One thing I always counsel parents, and I get a lot of calls usually around August about the Parent Plus loan, is that they'll say, but I want it in the student's name. I want them to complete it. And then I want a cosign so I can get released. On private loans, most loans will have a cosign and release option, but the parent's FICO is not strong enough. And so we'll talk about this in a minute, but one thing about the Parent Plus loan that I always like to remind people of is that if you are a little bit credit challenged, meaning a FICO score of less than 640, less than 650, or you have multiple kids in college, you're just looking for a way to finance it, the Federal Plus loan allows you to borrow up to the cost of education less all the other need and aid that your student has gotten. So if your expected family contribution, say, is $36,000, you can borrow that. But what Debbie said is really important to remember. It's in your name as the parent. So when they graduate, you might have an agreement with your son or daughter to say, well, you're going to take this over. But I mean, you're eating dinner with these 18-year-olds, right? They have no idea what you're talking about. So it's a lot of debt. And someone just asked in the chat, like, how can we hear about, this ridiculous student loan debt that's existing when you can only borrow the 31? Well, sometimes parents have the expectation that the student will take on the payment, or there's a private loan involved. So it's a good program, but something that has to be used very carefully because you as the parent are responsible after 4 years if you borrow each year.
And actually, that's a really good question about how come, how did the student debt become so large when they can only, borrow up to 31,000? Several years ago, when I used to see those numbers, it pained me because they weren't explaining the full story. And the full story is that a lot of that debt is driven by the Parent Plus loan that they weren't really disclosing in a lot of the news when they would share it. So it's a very valid question. I mean, a lot of the debt is driven by Parent Plus loan and graduate loans for very high cost degrees.
Excellent point. And one thing I think we can answer to that's come up in the Q&A quite a bit is the FAFSA. And so the FAFSA, and we can, like Debbie mentioned at the beginning, we've done programs on this. We're happy to send it to you. The FAFSA should not be something that's avoided. Do not think that, I make so much money and the school's going to find out and something bad's going to happen. It's not. Your information goes into an algorithm and a program, and it spits out numbers and it says, Debbie gets this or Debbie doesn't get this. It's not going over to alumni relations for donations. It's not being used to direct mail anybody. But time and time again, what we see is parents say, I make too much money, I'm not going to fill it out. And then there's job loss halfway through the year. And so you would become eligible for some of the programs. So you may want your student to take out the direct loan in second semester and you haven't completed it. So we're not just preaching here. We both believe in it. Everyone should complete the FAFSA. And then just let's see what happens when you get the reports from the school and the award letters. You'll see what you qualify for, but it's not something to be avoided for sure.
Actually, there's a really good point I realized I missed, Melissa, if you don't mind going back to that chart with the limits, is that your student can only borrow these federal direct loans in the year that they are, in school. So if for whatever reason you decide, and you and your student decide, well, we don't need to borrow it freshman year, so we're not going to take the 5,500, but sophomore year, I need more than, or your student needs more than the 6,500, and you didn't borrow the first year, can I borrow some of that money now? And the answer is no. This is a year by year decision. And I see some questions too. And because of that, that's why you need to fill out the FAFSA every year. If your student wants access to this money, you need to fill out the FAFSA. Each of these years, each loan is a separate loan. That's why the interest rate is determined differently. But whatever the interest rate your student gets on these loans, starting July 1st of the summer before, that's the interest rate that lives with that loan throughout the whole life of the loan. So your student does end up graduating, depending on how many loans that they take, they will end up graduating with these separate loans. One other piece of advice that, I've heard financial planners provide, and I think is valid, is sometimes parents or students, or they have their student take out the loan at the beginning of the year. They're not quite sure if they're going to need it. And then if they figure out that they don't throughout the year, then you can pay it back. You can pay it back immediately, and it's not a penalty. So you can use that flexibility too, knowing that if you didn't take it that year, you basically lose access to it.
Yeah. And one of the things too that someone just mentioned in the chat that I want to address is that they were granted the Parent Plus loan as part of the award letter.
I saw that.
It makes me mad. It's not an award. It is a loan, and schools should not be doing that. They should not be putting the plus loan in there to have your amount owed be zero. So you could decline it. If it's in your package, there's one school I know in Connecticut that does this. They put it into everyone's financial aid packet, and it says, there's a box, yes or no. Say no. You don't have to take it. Absolutely.
Until you decide. But, and then you can still say no, and then a month later decide you want it. But, until, right. And I saw somebody made the comment, the Parent Plus loan is not awarded, kind of what Melissa said, not awarded by the school. It is basically a financing option that the government gives you. The school really has nothing to do with it other than to confirm that your student is going there and what their cost of attendance is.
But sometimes we see it pop up. There's actually kind of a lobbying effort to get it removed from award letters, because we do see schools showing it up and listing it as a line item in your award letter, and it really should not. That should really be need-based, grants, other merits, things like that. And so we're working hard for y'all to get that out there. Yeah.
So somebody's asking, well, first let me kind of clarify. Would I recommend that a student take? I would absolutely if your student is offered subsidized loans, I would take it, because basically, I don't want to call it free money, but they are basically giving you money that is interest free while your student is in school. So that's a gift in some way. So definitely take it. In terms of the unsubsidized, that's, again, depending on if your student, if your family needs to borrow, we're going to emphasize this over and over again. If your family needs to borrow, your student should take out the federal direct loans first. They should maximize what they can get in these federal direct loans. And then if you need more money after that, it's a decision between a Parent Plus loan and a private loan. But none of us would say, don't take out the federal direct loans and go directly to a Parent Plus loan or go directly to a private loan. We want every student, if they need to borrow, to always borrow the federal student loans first.
Yeah. And Deb, one of the questions about it too was, at a needs met school, the amount based on the student's award letter was actually less than the 5,500. And there, the parents portion or the EFC was separate than that. Can they increase the amount up to 5,500?
Yes, I would go back. I mean, unless, and I don't see the question, unless you're referring to the subsidized loan has a max of 3,500. So if that's what you're referring to, then that might have been the case. But above the 3,500, your students can still get the additional $2,000 in an unsubsidized loan. So everybody, whatever combination of subsidized and unsubsidized, their student can get up to 5,500 freshman year, and you should make sure that they will be able to do that.
And to Douglas, you will see the unsubsidized loans on the award letter for sure, because those are awarded. Their students filled out the FAFSA. It's the parent loans that are a different kind of beast and don't usually show up on the award letter. How do we access the Parent Plus loan? Do you want to take that one, Deb?
Sure. You have to go to it's through the government site, because you need to have your FSA ID to get it started. So it is, and that again, that's why it's not through the school. It's through the government site where you've started your FAFSA and have your FSA ID.
And the school will generally have a link in there. A lot of schools use awarding software, or like my son goes to Sacred Heart. It's called Shoe Awards, where you can log in and see the bill, and there's financing options in there, a link to studentaid.gov, which is where these applications are. So I know a lot of you are pre-college right now, 11th grade or middle school, 10th grade. You are not set off on your own to figure this out. The information will come from the school, but it will just be in the award online tool that the school offers or on their website. They'll send you an email. But to Debbie's point, when you're completing the FAFSA form, you establish a PIN, like an ATM PIN. That PIN will stay with you year over year. You'll use that to log in to complete the FAFSA each year, and you'll use it as a parent to do your plus loan if you choose. I used to take that thing, write my PIN on it, completely not secure, and tape it to the inside of the coffee cabinet, because I knew I had to go back every year and use it again. Yeah, very old school. Did we talk about rates and fees?
Yeah, no. So what's really important to understand about the Parent Plus loan is it is one fixed rate, which is, again, a big difference between the Parent Plus loan and a private loan. The current rate, and the same thing applies, that these rates will change based on the 10-year T-bill in May. So we don't know what your Parent Plus loan rate will be, but for today's current college parents, the Parent Plus loan rate is 7.54, a flat rate, whether you've got great credit, whether you've got not so great credit. Everybody pays the same interest rate. And what's pretty hefty, and this is why we kind of explained what origination fees are, there is an origination fee of 4.228% that is applied every time you take out a Parent Plus loan. So if you have to take out a Parent Plus loan in freshman year, sophomore year, junior year, senior year, every loan that is taken out has this origination fee applied. And what we want to encourage people to do is, when you're comparing rates, I wouldn't take the 7.54% rate from the Parent Plus loan and just compare it to a private loan. Most private loans, which Melissa will go through, don't have an origination fee. So you want to factor in what the cost of that origination fee is. And I don't have the exact number offhand, but I bet you that if I included that origination fee, it would be an interest rate that's over 8%. Yeah. So that's where how you need to compare apples to apples, by including the origination fee in with the Parent Plus loan rate, and then compare that to a private loan.
And Debbie, one of the questions that came up is, do we recommend the parent on the plus loan? We absolutely recommend no loans, no kidding aside. Like, we don't want to see people go in debt. If you need to borrow, our advice tonight is for certainly to have the student take the subsidized or the unsubsidized, because the rate is so low, generally, that it's a good way for them to establish credit. It's a good way to help the family. You probably need to save for retirement. But I appreciate the question, because we understand people have to borrow, and that's why we're here, but we really don't recommend borrowing if you can avoid it. I know that sounds kind of
And
idealistic,
I mean, I don't know, Melissa, if you would, support this. So I think what we do recommend is research. So
Yeah.
is understanding what we're talking about tonight and then researching your options.
Yeah,
Um,
absolutely.
And that's honestly how you're going to make a decision, is understanding the pros and the cons of all these different loans, and then comparing the interest rates and then the features and the flexibility you may or may not have with each loan.
Exactly. And one of the things, and I don't think we don't go into it here, but one of the things that everyone's heard about, I'm sure, is the student loan moratorium that's been going on since COVID started. So, and I'll use a real life example. My own son graduated from college in 2019 and has never made a student loan payment on his federal direct loans, not one, because it has a grace period on it. The federal programs have a 6-month grace period. So we graduated in May, and he was supposed to start in January. And that's when they declared the public health emergency, and student loan payments did not have to be made. And there's been continuations over the past now 2.5, almost 3 years. So students not only have not made payments, whether they graduated or not, but those of you that have kids in school right now that had plus or subsidized, unsubsidized direct, no payments, no interest accrued. So they've gotten a nice benefit. The debt's still there, but no one's been making payments. That's all going to start up again. We expect this fall or towards the end of the year. And so that is one difference. People have not been paying. So those of you that watch the news, I know some of you have brought up the debt limits and things like that. It's going to heat up a little bit more when we get millions of people back to repayment that haven't had to make a payment in 3 years.
So isn't the date, I mean, it's a combination of they're waiting for the rulings for some cases that are in court, but it's also, if nothing happens, it reactivates as of 60 days after June 30th.
Yeah.
So that would be the end of the summer.
Yep. But we've seen, I'm going to get the number wrong. During this administration's time, I think they've said, we will not extend again and extend it
and then
2
they
times.
extend. Yeah.
So yeah, we're just waiting. We're just gonna wait, just like the lottery. We'll see what happens. All right. So a lot of good questions are coming into the chat about private loans. And Deb, can you see the Q&A?
Yes, I can.
I'm going to turn it over to you.
Okay.
So someone just asked, what is a private loan? And a private loan is a loan that's not made by the federal government. So it's made by lenders like SoFi. Other names that you might have heard are Citizens Bank, Discover, Sallie Mae, all lenders in the student loan industry. And the difference is, as we saw in the early parts of Debbie's presentation, especially at the undergraduate level, there are caps on what students can borrow. So let's use the example that I started out with, that Debbie's my child, and she's a freshman, and she gets $5,500 and she's going to nursing school. But I do not want to take any debt in my own name. So the plus loan is out. Debbie's on her own. And I say to her, well, you know what? I'll help you by co-signing the loan while you're in school. But when school is over, I'm going to expect you, Debbie, to take over the payments. That's this type of program. While there are private parent loans, which you can see on the right hand of the slide here, that are only in the parent's name, much like the plus loan, generally there are no fees, and there's a lot more flexibility in interest rate type, term. And we're going to talk about this stuff in a minute, but length to repay, or maybe you want to make an in-school payment, all different options in the private world. But there are protections in the federal programs that don't exist. So like Debbie said, really worth the research on which one fits your family. Loans are generally, depending on the lender that you use, if your son or daughter has no FICO score, they are underwritten based on the creditworthiness of the cosigner. So it's nice. Like if you have a 19, 20-year-old child, you're going to cosign, and obviously they have no income, we'll underwrite to yours, but they're on the loan too, and start establishing, a credit history through that. Unlike federal loans, not all private loans have origination fees. I would dare say I don't know any that do have one. So that's one big difference. But always discuss with your student, how the loan works, how interest rate works, and the amount they might have to pay each month. We are lucky that so many people like SoFi and others have invested in calculators. On our website at SoFi.com. You can also go out to sites like NerdWallet has a really good calculator on calculating how much interest you'll pay over time and what your payments will be. So definitely something to think about as you're going into planning, especially high school folks. And Debbie and I always say this: do not look at the academic year as a secular time. You have to plan for 4 years, right, Deb?
Yes, absolutely. And honestly, that's what's so great about families who are here with 11th graders. And and you don't have to have started early. It just gives you a benefit. But parents, with 12th graders and older, you should be looking at the whole 4 years and figuring out how you're going to use whatever savings you have, whether it's from 529s or you can take it from current interest. How you're going to use the student federal loans, and what aid you might get each year, and then look at what's left over, and if you're going to, and then this is honestly where you can kind of fool around with the numbers and see, well, what if I took the Parent Plus loan and it's this rate? What if I was able to get a private student loans using the calculators that Melissa's talking about, and it was at these rates? And then you can look at what the student's monthly payment is going to be after graduation and what your monthly payment might be after graduation.
Yeah, absolutely. And it's a simple, you could do it on a piece of paper. You don't have to be spreadsheet, cranking out the numbers. But as you saw, your loan limits go up for the student every year. How much are you willing to pay every year? And then what do you think the gap would be? And then just determine what the payments after 4 years will be. When people do that, they find money. They say, you know what, we're not going to borrow that much. So definitely worth the time. It's scary. None of us want to look at it. It's a reality we have to face. But definitely something to plan way in advance. Okay. Pre-qualification. Some lenders offer this. SoFi does, that you can come to our website without a hit to your credit bureau and put in your student's information and your information and find out if you'd get approved, or find out what your interest rate would be without having to go through the whole application. So definitely something to think about. One question just came up: what's a good private loan rate? What's the average? It does seem high right now. So I'll give you, someone was quoted 9.8%. Just over about a year and a half ago, before the interest rate and the inflationary adjustments and everything, we were looking at rates around the 5 and 6% mark. So that what we call kind of the base rate, benchmark rate, that banks have to borrow money at is over 4%. And so a year ago, it was at 0.25%, which rates were low. So it's not the lenders kind of gouging you, it's their cost of funds plus a margin. So that's why the rates are a little bit higher. On a 15-year, which was the question, the federal loans that are offered plus and direct carry a 10-year repayment term.
That was an question to an
Oh,
earlier answer. But this is the comparison between what's the features of the different loans.
Exactly. And we can jump ahead too and get into some of this, but and I'll finish pre-qualification. The main benefits to pre-qualifying is to find out quickly if you're likely to receive the loan and how much you'll qualify for. So this is all done without having to fill out an entire application. You'll get an expected range, and students will generally need a cosigner. And someone asked this question: can a freshman get a loan without a cosigner? I don't want to, if they're working full-time and have a full-time job, yes, but it is likely it's never going to happen, because and it's not that lenders are mean. The government and our regulators say, do not make a loan to someone that has not shown the ability to repay. And the ability to repay is not the promise of future earnings 4 years in advance. It's could they pay the loan now, which is why we need the cosigner. So unfortunately, we get that question a lot. There's no one that I know of that offers a private loan to freshmen without a cosigner.
Not freshmen. There,
Yeah.
right, there are some lenders a little later on, like when you're,
Juniors and seniors. Yeah.
yes. And honestly, just from like, and you can correct me, Melissa, from like a credit standpoint, the reason why they're more willing to maybe do that is honestly, your student is much closer to graduating.
That's
So,
right. And they know how those probably majors perform. Yeah. Okay. So pre-qualification, will it affect your credit score? The one that SoFi offers on our website, which is through a check your rate tool, is a soft inquiry and does not affect your credit score. But submitting a loan application and going through the process, and it will tell you actually on the screen, no matter what the lender we are submitting for credit, this is, this is going to be an inquiry on your credit. Do you want to move forward? Is when you would see that. We don't recommend that you apply for loans before your child is ready to go to school. It's a good idea to have to pull your FICO score. So many places offer that for free. Because lenders don't always use FICO as the determinant, but it is part of the criteria. And so there's comparison sites you can get some of this information on, but best to know what your FICO score is. And I get this question a lot too over the summer is, but I had to buy a car. We had to buy this, we had to buy that. The school does not care. The school does not care if you're buying a car or had to take out credit or, and can't qualify for the loan. That's not something they're going to say, that's okay, we'll give you money since your credit is bad. So, or less than optimal. So something to plan for. Now, for those of you that are in high school. Okay, loan features that are different perhaps than federal, or some are the same as cosign or release. Something that you should look at for those of you that don't want to take on the burden. Does the lender offer cosign or release, and what are the conditions of that? So at SoFi, we require that the student be in repayment for 24 months, so they can establish a history, and then they can apply for release. What is the interest rate? What is the interest rate? Does the lender offer interest rate discounts if I make automatic payments? Which is an awesome feature. And so one of the things is that if you sign up or the student signs up when they graduate to make payments, automatically withdrawn. And how many of us do that today? With cable, cell phone, some lenders will give 0.25% reduction. In fact, there are other incentives that lenders may offer that you might want to research. So for example, at SoFi, if you come back a second year, freshman and sophomore year, we'll give you an additional discount. There's one lender out there that offers, $100 upon graduation. So there are some different things or incentives that can be offered to help pay down the debt, and something you should research as you're looking at loans. Repayment. Does the lender assign the repayment term, or do I get to choose? If you want 5, 7, 10, what number do you want? You need to research a lender that's not assigning it to you. Some lenders just say you get X. Some lenders let you pick it. The length of the term. Are there incentives for shorter term loans? So this is definitely a good rule of thumb as you're looking for private loans. If you pick an option to repay, which says, I want to start payments immediately. While Debbie's in school, I'm going to start paying immediately. You're going to get that lower rate. So when you look on a range today, you're probably looking and researching, and you see that it'll say rates from 4.5 to 13%. That 4.5 rate is going to someone who is paying immediately and taking usually a 5-year repayment term. So that range covers not just credit, but the term and the type of repayment that you select. So shorter term loans will be cheaper. And if you choose to pay in school on the private loan, your costs will definitely be lower. There are no pre-penalties. This is like something that's talked about every year. No one charges a prepayment penalty. I think that's only a mortgage term. We talked about term. And then what if you face hardships? Loan servicers will work with you, especially during COVID and some of the disasters that we've seen, whether they be weather related or other. The lender lenders do not want you or your student to default or become delinquent. We want to help. And so, yes, if you run into problems with unemployment or a health concern, just call the lender. Don't avoid it. They will help and work it out with you.
So Melissa, before you go on to the when to apply, there's a question about when you take out the loan, are you taking it out for the full year?
Yes.
Or can people take it out at different times of the year?
Great question. Always take it out for the entire year. So if you're applying and your student's going to school for the whole year, if you apply for 10,000, we will disperse, it gets dispersed however the school wants it, which is generally twice, unless they're a quarterly system, a quarterly year. So say the first bill's due July 1st, we'll disperse to the school on July 1st, and then we'll disperse the second disbursement on December 1st when the second bill is due. We work with the schools, we know when they want the money. There's a process called school certification. So say you apply for a loan for 15,000 and the school says, oh no, Debbie only needs 10. We've given her a lot of need-based aid. She only needs 10. The school will send back and say, no, reduce that loan to 10,000. There's only a $10,000 need. That's called school certification. All the lenders do it. It's done electronically and it's seamless to you, but it's the school saying, yep, she can have it. And that process takes place once for the whole year. Now, some people think, oh, I don't want to pay interest, so I'm going to apply twice a year. Don't worry about it. You're only charged when the bill is due. And if you do that and apply twice in the same year, those are 2 hard credit hits that you don't need. So once for the full year.
So just to emphasize again, if they took out the $10,000 loan and the school only asked for 5,000, they're only paying interest on the 5,000 initially.
That's right.
And then interest starts on the second 5,000 whenever that other money is dispersed.
At the second semester or the second bill. Yep, absolutely.
And for whatever reason, if they don't need it, the money later in the year, then they can actually say, to not disperse it.
Yep, and you can apply anytime. So say, for example, you decided you're going to pay cash in the fall, okay, and you make the cash payment, and you're like, oh, you know what? For the spring semester, we're really strapped. We don't have the cash. You can apply then. There's no, you have to apply in the fall for the whole year. But if you think you're going to need it for the whole year, apply once. But you can apply in the spring or halfway through the spring, or as long as it's within the loan period, you're good. Apply when the tuition bill arrives and the full amount you need to borrow. And I saw that question here. Yep, 30 days is really kind of the sweet spot. One of the things, though, that is the question that we get at SoFi, and I'm sure my comrade, other lenders get it constantly too, is that we have some early birds that will come in. May 1st is decision day. We've deposited at Penn and we get the bill and it's not due, say, till August, but you want to get everything out of the way and apply. You can take that loan all the way through the process, but it will sit in that process I called school certification. Say you complete your loan app on May 30th and you're like, where's the money, Melissa? I want that money out the door. The school will not take it until the bill is due, which is great for you because of the interest. So you could finish in May. The school may not come to us and ask for the money till it's due in August. Not to worry. The loan's approved. Once it's locked in, you have nothing to worry about, but the school will decide when they can take it because they have regulations too. They can't take your money 2 months early when the tuition's not due. That would be interest that you're getting charged and interest that they're gaining. So it's some really great checks and balances on how the loans get dispersed. Okay. Some student loan tips, pre-qual before your first tuition arrives for lenders that offer that process. Plan for the 4 years. Debbie, I feel like we should trademark this.
Right, plan for the 4 years.
The MEL-DEB, the DEB-MEL. It's the 4-year plan and understand what the monthly cost is going to be. And then talk to your student about salary and career expectations and research them together. They should not borrow more than what they expect to make the first year after graduation. And that's an awesome rule of thumb. And the 31,000, you all can kind of figure that out, simple calculator on if they borrow the full boat for undergrad, what would that payment look like? And it's usually a couple $100, right? 250, 60, 70, very, very doable. It's when we get into private loans and you're asking the student to take it out for all 4 years because you're not going to contribute or the family is, wants to preserve cash, is where that payment can get bigger. And I counsel my own friends about this that take out plus loans and parent loans. I make them sign a fake letter that says, Melissa has told me that $1,500 a month after graduation it's just not reasonable. And I think sometimes we just put it off and say, I'll worry about it then. I'll help them then, but better to get the budget snapped in the freshman year on what you can afford after graduation.
So Melissa, there were a few questions about when a student and parent have to start paying back the loan. And I know you kind of mentioned that a little bit with private loans, but
Yeah.
if they put off, paying back the loan, somebody also asked about capitalization. Yeah.
Yep. So in the private market, you can choose, again, some lenders do offer this, I know, and some do not offer the option to pay. But there's something called in-school deferment. So let's just, for example, say you're taking out a loan, Debbie's still in nursing school, we're going to take out $5,000 a year, and we're not going to make any payments while in school. We're going to defer it until graduation. The interest will accrue while Debbie is in school, separate to the loan. So like the 5,000 is here and the interest is over here, and we're, this part's growing, 5,000 is staying. It will capitalize, which means being added to the balance, the principal balance, at the time the loan goes into active repayment, right after graduation, which is nice. So both on the federal and on private, the interest generally does not, at least on the private side, does not capitalize until they're ready to go into repayment. Caution though, at SoFi, I know a couple of Citizens is another one. We offer 4 repayment term types: pay now, pay interest only, defer, or make a small nominal payment. What you pick at origination is what will go with that loan for the life of that loan. And so if you decide to make payments while the student's in school your freshman year, and then 3 payments in, you say, I don't want to do this, you cannot change it because the loan was originated that way. Your sophomore year, you can change it. Junior year, you can change it. But it's something that parents say like, oh yes, I want the low rate. I want the low term. And then in the second year, like, oh, I can't take on another payment like this, while they're in school. So just be mindful of that. Deferred loans tend to have higher interest rates because you're not paying and the duration is longer. I hope that answers the question.
And that's kind of when you do apply for a private loan, right? They'll be given back options. It's kind of like different configurations of the loan.
Yeah.
All these different configurations equate to potentially a different interest rate, because
Correct.
it's all based on the risk of you paying back the loan. So if you're paying back within 5 years, you're less risky than somebody's going to take 10 or 15 years. If you're starting to pay back while you're in school versus you want to wait longer, that fits in, it plays into what your interest rate might be that you're offered.
Yeah. Yep. And then to George, your question about consolidation. So on the federal side, more generally and almost usually, when you borrow from the federal government, they'll send your students' loans to one servicer. So they'll get one bill. On the federal side also, you can call up if you don't like your due date and say, change my due date. I don't want it to be the 1st. I get paid on the 15th. Most lenders will do that too on the private side. On the private side, if you borrow with one lender, so say you took out, the student went to school for 4 years, they took out 4 private loans, we will send one bill, right? Combine. But say your student has federal loans and private loans, and they want to refinance them at a lower rate, which is also something SoFi offers after, for students that are in active repayment, they can do that. So there's a lot of vehicles available to students when they graduate because they're older, they have income, they can probably get a different rate on their own. So, yeah.
And
all right.
So, there's one last question about, and I know we mentioned this, but about the, can you apply for the full 4 years? And maybe the only thing to clarify is, to be honest, there's a lender out there that kind of gives you the impression that you can apply for one loan for 4 years. And it's really not the case when you understand the details of what's happening. So every year you're going to end up, they're going to have to pull some sort of a credit check. And every year they're going to have to give you a different interest rate for that loan.
Right. And if you're on the 4-year program, you do get approved up front. What's nice to know too is that if you don't go through their pre-qualification, you get declined, or you only get offered 1 year, you didn't qualify for the 4, which is another way to look at it. But to Debbie's point, nothing will cover all 4 years without you doing work. Because if every year you're taking on debt, right? So say you have job loss or your FICO score goes down, that's not a guarantee. They're going to check your credit each year behind the scenes. And if you have some type of credit disruption, you're not guaranteed those funds.
So,
Yes, but you'll borrow every year.
So there's a question, I mean, how this relates to private loans. If a student decides to go to grad school, can they continue to, well, what can they do about if they took out private student loans? When do they have to start repaying them?
They could defer them. So lenders have a deferment policy for graduate students. Like, we'll cover up to people going to med school, something, whatever, if they're going to law school or whatever program the grad is. Generally, everyone offers 2 years, but it's the longer programs that you'd want to look at to see what the specific lender was offering. I know we're hitting up against time. The only thing I want to talk about on this slide is the tuition installment plan. This is the unsung hero, I think, of college financing. And sometimes we think it's too good to be true. So most schools, if not all, offer either a tuition installment plan or 10-month plan where you can say, I'm going to pay what I owe over 10 months. There is no interest. There's generally a setup fee, $35 to $60, something like that, that you pay to the school. And I think parents don't fully understand it because they don't understand, why would the school let me do that, not charge me interest? Why is it not a loan? That's the great thing about it. This thing has been around since I was in college. My parents did this, but it's a nice way to manage payments across a year versus having to come up with a big sum twice a year. And the tuition installment program, you could even do, say you had your expected family contribution was 20 grand and you only want to do this for 7, you can say, I'm going to pay them 10 months. It's such a great option. Often not talked about enough, but as you're doing your 4-year plan, even if you can afford to pay $3,000 into this plan, and that's $3,000 not borrowed.
And if you don't see it someplace, like call and ask the financial aid office.
Yeah, for sure. Absolutely. So we're going to send this out. I know we're at 8:58. We're going to send to everyone this presentation. And Debbie and I just want to say thank you, everyone. We had almost 200 people here tonight. So we hope you learned a lot. It's a lot of information. So the presentation will be emailed to you. And I want to offer to everyone the SoFi Paying for College hotline, which is listed here and will be in the presentation that you get. This is a hotline that is not for product promotion. We have actually financial aid people that are on the phones, people that are deeply trained in FAFSA, in reading award letters, and can help discuss your individual case about financing or your award letter. Our goal here is only education. So no one's going to offer you a product or say, let me take a loan. Really cool feature. And through this, we probably get at least 20 calls a week. And that link, you get to pick your time that you want to set up. So you might want someone to call you at 8 o'clock on a Thursday. And so that's a link to the calendar, and we will do that. So
this is great. This is really wonderful that you offer it, because, you know, it's like one thing to hear all the information, then when it comes down and you're doing it, you always run into questions that you hadn't thought about.
Yeah, for sure. And then lastly, I know we have a lot of people from our SoFi at Work program here. Go to your employee internal intranet and look for the benefits. So some of your companies will offer an additional benefit on top of an interest rate discount or maybe a pay down of the loan. And for those of you that are looking at refinancing, even for yourselves, always go to your company website, because I guarantee you, if you're a big company, there'll be an offer there that someone is offering for refinancing. So I think we hit most of the questions. If there's any last questions, throw them right into the Q&A and we'll try and get it in the last 30 seconds. Thank you, Carmen, for the shout out. We do not charge. It's just, you know what, the better educated consumer, the happier the family. And we believe that. So, all right, I think that's it.